All right, let's get started. So, as a just upcoming events, our next speaker is Joel Tillinghast on November 4th from 6 to 7 in the auditorium. I used to work with Joel at Fidelity. He's like an amazing investor. He started the Fidelity Low Price Stock Fund, one of the best all-time performance funds ever. He's a brilliant investor, unique insights. I would strongly recommend you all, actually attend this. It's free, and to listen to someone of his caliber, I mean, we're lucky that he's willing to come. So, the best way to learn is by listening to others who are smarter than you, and Lord knows Joel is 10 times smarter than I'll ever be, and he's kind of a character, but I ran into him at a party back in April, and I told him about what I do at BU, and I said, would you come to speak? He goes, I'd love to. So this is the fruits of my networking. Anyway, there'll be signs up at the end of the week, but if you want to, register now, I mean, again, it's rare to get people of his caliber to BU. Okay, modeling, something that you all, why you're here, right? But we spent the first section on the first module on accounting, because having a basic knowledge of accounting is super helpful with financial modeling. You're going to be looking at, this company financial statements, and they're going to include a lot of like what are they talking about? And so hopefully you've got some sense of why we need to essentially transform the GAAP accounting statements, which are accrual-based, to cash flow statements, which is what we care about in finance, right? We care about cash flow. It's how we value companies. And so we need to go through a process of converting GAAP accounting statements, which are accrual-based, based on a period of time, into something that's cash flow-based. The second section, what we just did, is on industry and company analysis. And this is like, one of my pet peeves. Most people who teach modeling, they teach it, basically it's it's an academic, it's just like, last year times 1.10, right? And there's no thought into the inputs, right? And the last piece we're going to, at the end of the semester, is on valuation. So if we are modeling, by definition, we are forecasting out into the future. How can you possibly forecast a company's financial statements without some sense of, the industry, the company's position within it, the sustainability of its margins, how good is its business model? Is its business model, susceptible to attack, et cetera, et cetera, et cetera? And so critical that we start any type of, before we model, we do a deep dive into the industry and the company's position within it, which is what we did. Now, in some of the classes I teach, in my securities, and we spend 3 weeks on strategy. To me, strategy, and this is a advertisement for the strategy, it's one of the most important things you can take at BU is strategy, because really, if you look at investing, it's all about strategy and forecasting the future. What you're trying to do is ascertain whether this company's go-to-market strategy, its mousetrap, is better than anyone else out there. Critical that you understand it, because that's going to enable you to forecast the future better. But today we're going to basically do historic models, right? We start with the modeling historically, right? Once we've developed a historic model, then we can actually forecast into the future, right? So today we're going to be based on historic modeling. Next week is going to be on forecasting. And as I should have started, so I commend all of you for being here today, right? Some of you are, freshmen, sophomore, juniors, maybe a couple seniors, right? So, unfortunately, we live in a very competitive world, and your ability to succeed in the interview is going to be based on talking about things that we're talking about, this semester in this modeling and, valuation seminar, that I am putting on. So I commend all of you for showing up, right? Showing up is half the battle. If you show up, it means that you actually care. And by doing this, you're, as we talk about in strategy, you want to compete to be unique. Well, you all are competing to be unique by being here and going the extra mile. You're not getting any credit for this. You're really doing it because you care about your career and you're trying to, do something that others aren't willing to do. So what is the purpose of a model, right? If we step back, yes, there's an accounting aspect. We want to identify the value drivers. Each company has a unique set of value drivers that, enables the company to, what matters at the company. What are the drivers that enable the company to create value, right? As potential investors, we're trying to understand what are the value drivers for this company? What metrics matter, right? And by modeling a company, and especially historically, the part of just entering all the numbers in, you start to understand what really matters at this company. So in the classes that I teach, and every semester I get a couple of students who think they're smarter than me, or all my students are smarter than me, but they think they can pull a fast one on me. And so when their historic model is due, they send me something, and it's clear what they did. They downloaded it off of FactSet or Bloomberg or whatever. That is like death, all right? And it's because you're gonna end up doing 2x the amount of work. So you need to actually physically input all of the numbers, balance sheet, cash flow statement, income statement, into the model itself. And what I've learned over the years is by typing all this information, you're actually learning the company through osmosis, right? You're starting to understand what matters. The only way to really do this is by inputting the numbers yourself by hand. And over time, you actually get faster, okay? Don't download the historic financial statements because you're going to end up creating huge amount of work. It will not end well. And also, a lot of the companies, their statements, they start with the most recent statement and they work left to right, where we always work right to left, right? So we want the most recent year on the right-hand side and the last year on the left-hand side. So we start with 2020 on the left-hand side and the years that we're forecasting on the far right-hand side, right? This is not easy to do, right? Identifying you need an understanding of the company's business model. We're trying to understand what drives value creation for the company, and each company is going to be different, right? Once we identify these value drivers, we're going to track on a quarterly basis, right? We want to put the things that matter at the top of the model. Yes, the model is for your own use, but if you actually are doing this for a living and you're sending it to your boss should easily look at your model and understand what are the value drivers of this model. Each company or industry is different. If you are in my other class, the valuation class, we just modeled Shake Shack. What drives Shake Shack is the number of restaurants they add and their same-store sales. How much are they, can they grow same-store sales through each box that they own, right? It's going to differ. Like if you were to model Union Pacific, a railroad company, it's the amount of rail shipments that they can do across their track structure on a quarterly basis, right? But we always put these at the top of your model. And good models should tell a story. You should be able to determine whether the company has been a good stock or bad stock just looking at how things transgressed over the course of time. Analyze trends. We want to, so you may, have a perspective on this company and what it does, and you may be super positive about it. But what a model does is it forces you to quantify your views of the company, right? You're going to set your own internal expectations about what their company can do. And when the company reports, you actually compare what the company reported against your own internal expectations. Again, identify the drivers of a company's performance and take all these inputs to determine a company's value. In the end, we want to be able to value the business, right? The only way to value the business is to basically have all three financial statements, the income statement, balance sheet, and funds flow. All three statements help us determine what the company is worth. And the last point is, and we'll get to this in valuation, your valuation analysis is only as good as the inputs, right? You can have a 4,000 line fanciest Excel, spreadsheet known to man. It could have macros. You can just dazzle and razzle and dazzle the user. If your inputs are worthless, the valuation's worthless, right? So in the end, your valuation is purely what the inputs of your model come from. Again, so why is modeling so hard? Why do my students struggle mightily when we get to the modeling aspect of my class, right? Accounting statements are compiled using GAAP, as we discussed in the first lecture. GAAP is accrual-based. As finance professionals, we care about cash flow. Converting GAAP financial statements to cash flow, it can be challenging, right? So what makes a good, easy to read, well laid out logical flow? The linkage of the income statement to the cash flow statement of the balance sheet. When we talk about modeling a company, the income statement is one of the three statements that we model. We need to model all three. They all are interrelated, and I try to, in a crude form, show how three of the statements in the first class in accounting, right, conveys the necessary information to decision makers, right? Chances are, if you work in investment banking, or you're going to get a job at Fidelity or MFS or Putnam, you're going to be sending your model to your boss, who's going to look at it, and you want to be able to convey the necessary information, allow them to read it, right? And it sets expectations in a format that allows the decision maker to compare the actual results against your assumptions, right? So bad models, too cluttered, mixing of quarterly and annual results. I don't have a blackboard here. The thing, and this is specific to me, is that sometimes people will do quarter, year, quarter, year. I like to have the years on the left-hand side and the quarters on the right. And to me, and you'll see this in a couple of examples I'll show, it's helpful to see the progression of revenues and margins on a yearly basis. That gives you a sense of how has this company done. If you have the quarters mixed in with the years, you actually lose that comparison, right? Not logically organized. There's something that's like too detailed. There's too much information. One of the critical things about modeling is to be able to determine what matters, right? And what matters comes with experience. So a friend of mine, last couple of years, has come and he's taught, he modeled Booking.com. And there's three business lines at Booking.com. There's airlines, there's hotels, and there's rental cars, right? He quickly determined that airlines and rental cars are meaningless in terms of what drives value for the company. What drives value for Booking.com is hotel rentals. So he spent all of his time modeling the hotel piece. And the other piece, who cares, right? You can model until the sun, it's not going to really change the value creation of the company, right? So he was able to determine hotel bookings drive value for the company. This is how I need to model Booking.com is on the hotel piece, right? No volume or price assumptions. The worst model on the planet takes last year's revenues times 1.10, all right? That's not how we model. We want to, if we can, break down revenues units times price, right? Funds flow and the balance sheet are not integrated. Critical that we have our funds flow statement and balance sheet integrated. Again, when we talk about modeling, it's all three financial statements. And if you're interviewing and they ask you about modeling, if you just talk about the importance of all three financials, modeling all three, you razzle and dazzle them, right? So suggested tips, over the years teaching this. So for the companies that you all are going to do, the best place to start is the most recent quarterly earnings release from the investor relations page, okay? And I'm going to be doing Meta tonight. So boom, here is Meta's investor relations page. Look at all this great information that the earnings slides, right? Earnings release, right? This is all the stuff that they actually give us, right? And each company has an investor relationship. Here is Meta's Q2 financial results, which I'm going to get to. So they give you, so this is where you should actually start modeling the company. Here is what they give us, right? So this is how we should, and we'll get to, lack of, some companies are great at giving us information. There's less, but this is where we're going to start with our income statement. Do not use the 10K to model the company. The 10K typically for the income statement, cash flow and balance sheet, usually the quarterly press release gives you much more detail in terms of how to model the company. All right, so this is where we start. And then Meta, I believe, gives us, where is this? Maybe it's up top here, which we'll get to. They break down the losses with Reality Labs and the main business. I don't see it here. I know it's in here somewhere. Yeah. Right, so now, we actually, they give us family of apps, which is, Instagram, WhatsApp, Facebook, etc., Instagram, right? They give us this, Reality Labs, and now they can say, wow, this company is losing a fortune in Reality Labs, right? That's good information to have, because over time, we would expect this to gravitate towards zero, right? So this is good. So again, we start with the company's investor relations page, and we start modeling the income statement based on how they have their income statement formatted, right? Start your model with the most recent quarter that has been reported and follow that format. Do not download the financial information, enter it yourself. It's going to end poorly as you try to manipulate it, right? Metrics that the company uses are most likely the most important. You should use these in the model. So typically, a company is going to report metrics that matters to the company, right? If they are reporting the metrics, this is what you should use. They are telling you this is what really drives their company, right? Again, avoid using the 10K for the income statement. It's probably going to be formatted differently and not contain the same level of detail as a quarterly press release. The 10K is appropriate for the funds flow and balance sheet, and use the Q4 press release for each year for the annual income statement, because it's going to contain more information, all right? So I like to always go to the company's quarterly press release for all of the information. Q1, Q2, Q3, Q4, and then use the annual information which they are required to report at the end of Q4 for the annual income statement. This right here will save you a lot of aggravation and wasted time. So the income statement, what it should contain: revenue detail, price and volume assumptions, right? Cost detail, the more inputs the better. Gross margin. Gross margin is a critical measure that we can learn a lot from in terms of the company and what it does for a living. Companies that have very high gross margins tend to add a lot of value. They tend to have a strong competitive advantage, right? Gross margin reflects the company's competitive advantage. Meaning, if you look at what gross margin is, it is the price that they're getting for the good or service that they're providing, less the cost to produce that good or service, right? The more value that the company adds, the greater, versus the cost to produce that good or service, right? The higher the gross margin. Why is it that Google, Meta, all these companies have 80% gross margin, right? They are adding huge value versus the cost to produce, that good or, that service. Software companies, Microsoft, they have a very high gross margin, right? Software companies have they have intellectual property that they are essentially getting paid for. The other end of the spectrum, retail, right? Retail, we really boil it down, they typically don't add that much value. So the gross margin, right, there is a pass-through. The gross margin tends to be very low. Manufacturing concerns, aluminum, copper, airlines, right? There's a lot of cost, capital intensity, that is depreciation costs that are reflected in that cost of goods sold. They tend to have very low gross margin. So it's important that you label gross margin, right? Gross profit divided into revenues as you want to see that gross margin percentage shown over time, right? So when I model companies, especially for my classes, I make everyone go back 4 years. So if you were modeling a company for 2024, you'd start with 2020 and end in 2023, okay? Operating margin. The difference between operating margin and gross margin is selling, general, and administration, right? Selling SG&A. And what we're seeing today, and particularly in the internet economy or in general, is, or any type of media business, is CAC, customer acquisition cost, right? Peloton is a poster child for this, right? The company's almost bankrupt, right? They have a very high CAC to get customers to buy their, bike, right? Other companies have a very low CAC, right? People love it, right? Airbnb, they almost have zero SG&A, right? Their selling costs are almost nothing. Right? Uber is the same way. Uber and a friend of mine made this brilliant statement, and I can't take credit for it. If the company you're looking to invest in, their name is a verb, buy the stock, right? Uber. I'm going to Uber it, to dinner, right? I'm going to Airbnb it this weekend. I'm going to Google it for the answer, right? Those companies have very low selling costs, right? But this matters because we want to convert as much of the gross margin into the operating margin, right? We want to minimize SG&A. Over time, as companies grow revenues, there should be some, we call these, synergies, right? Or there should be some operational leverage, because you don't need to hire a CFO for every $1,000 in sales you make. So we should see some SG&A leverage. As companies grow, the margin should increase as revenues increase. EBITDA margin, earnings before interest, taxes, and depreciation. We take operating income and add depreciation and amortization to this, right? The tax rate. We basically, income taxes divided by income before taxes. What is their effective tax rate? Share count. When we model companies and we're determining their earnings per share, we always use fully diluted shares outstanding. Primary shares outstanding, that's for losers, right? We use fully diluted shares outstanding. And we always put our growth rates below our model. And the reason is we want to actually, this is, again, modeling is very personal. So this is how I model. Wherever you end up working, your company may have its own format, and you will adjust to it. But what I'm trying to teach you today is like some basics that are going to carry through irrespective of the format. So each firm has their own idiosyncrasies and what they like. To me, on the growth rates, I like to have margins above and growth rates below. To me, being able to track the margins sequentially and over time, I don't like the model to be cluttered with growth rates. I like to see the growth rates underneath. So if you can, segment data is critical, right? Many times companies will not give you price or volume trends, but they will give you a breakdown by product area. Like, it allows you to determine which segments matter, right? And by forecasting the individual segments, it's going to be much better at predicting the whole company. So you have you can take the lazy person's route, take last year's revenues and multiply it by 10%, or you can try to, predict each line item. Each line item probably has its own set of dynamics and what is actually going on. And even if each line item is off a little bit, by trying to forecast the sum, even though it'll be off a little bit, by doing each revenue line separately, it's going to be more accurate than trying to do the overall company in total. Right? So again, the revenue details should always go at the top. Outline the components of revenue, price, and volume if possible. It should be easy for the reader to understand the underlying assumptions to arrive at revenue forecast. And again, you guys are students, but it can take many forms. Translate industry data to company specific, or price volume assumptions specific to a company. Now, this is what you're going to learn, with your own companies themselves is, they don't give you sometimes what you actually want. sometimes companies are unwilling to provide too much detail. They don't want this to get in their competitors' hands. So the saying that I say in class is you can only play the hand that you're dealt, right? And so you only can model, what the company gives you. That's why, again, it's important to actually start with the company's most recent quarterly press release. This is the hand that you're dealt. Your goal is to convert what you're dealt with something that that you can actually use. So this is Meta. As an example, this is what Meta gives us, right? This is all the information. They give us family daily active people. Their family referring to the various social media platforms, right? Daily active people was 3.27 billion on average for June of 2024, an increase of 7%. They give us ad impressions, average price per ad, and they also give us revenue. And importantly, as I said before, they actually give us a breakdown between Reality Labs and the overall and the and family of apps, right? So now they gave us a bunch of this data up top. So again, this is where having some basic understanding of the company is helpful. So Meta, they make all of their money off of what? Advertising, right? This is how they make money, right? What drives advertising revenues? People are willing to pay, advertisers are willing to pay the more eyeballs that are seeing their ads, right? The more relevant that their ad is, the more that they are willing to pay, right? It's basic. They give us family, daily active people. So I think it's fair to say the more people that are on the platform, this is they're going to be able to grow their revenues. So they really grow their revenues two ways: attracting more users on the platform and charging a higher price per person. This is how we can actually forecast their revenues. And this is what I did. So here is their family daily active people, and you can see over time how they've done a really good job increasing it, right? They give us family of apps. This is all revenues, right? If on the platform we get a revenue per daily active person or user, right? So again, how this company grows is by two ways: increasing the number of people on the app and by increasing advertising, the dollar per ad. So if you look at how Facebook, everything that they do is to do what? Is to make their ads more relevant, so the advertisers are going to be willing to pay them more, right? So in 2022, the company got crushed. What happened in 2021? Apple came out with their ATT, their advertising tracker, which basically anyone who was on an Apple device basically said, I don't want anyone at Meta seeing ads that I click on or when I'm searching for Google. Overnight, it changed their the relevancy of their ads, so advertisers were willing to spend less. We see this right in the dip in revenue per daily active people, right? In 2023 and this year, what did Meta do to counteract the change in the app transparency tracker that Apple put in its place? It invested a fortune into artificial intelligence so they know more about you in terms of how you interact with the apps, who you're friendly with, what interests you, what doesn't. So they've been able, through AI, to now, not seeing what you click on, they've been able to replicate that with artificial intelligence, and now their ads are as relevant as they were, and we can see the increase in revenue per daily active people. So by looking at this, it's quite clear going forward that what matters with Meta is their ability to drive revenue per ad impression higher. They're already at 3.32 billion users, right? They're not going to take this to 6 billion, right? So again, this is helpful, right? From understanding Meta as a company, what's going to drive this company higher is their ability to use artificial intelligence to make their ads more relevant and for advertisers to pay more. Gross margin, right? Here is their gross margin trend. Again, important to see gross margins over time. This is lost, by the way, if you would have quarters in between here and here. In 2022, we saw what happened when Apple put in place that app tracker. It crushed the company, right? Gross profit was down. And we can see what they've been able to do now with artificial intelligence once they were able to figure it out, right? But again, we can see the company hit a rough spot. We can see this from the model. Operating income, right? We can see how damaging that Apple change was in 2022. It's clear as can be looking at the margin levels here, right? And if we look at my 2026 forecast, who knows whether I'm right, this 45% is kind of in line with what they did in 2018. This is not a leap of faith, right? So this is, again, the importance of tracking margins over time. It gives us a sense of, of what's reasonable. I typically don't waste a lot of time with interest and other. It doesn't really move the needle. And when we are looking at taxes, we want to look at the effective tax rate over time. We take Inc. provision divided into income before taxes. This is our effective tax rate. Companies' tax rates move all over the place. Many times they will tell us what it's going to be in the future. I think 18 is a good estimate, but this tends to bounce around a lot. But in general, the company will tell us, or we use the most recent quarter or the year. We get to net income. We divide it by fully diluted shares outstanding to arrive at EPS. Then we always put our growth rates underneath, okay? And again, we can see what happened in 2022 and what's going to happen further, right? Now, maybe my revenue forecast is too conservative, but this is a big company. But 2024 is a banner year for Meta. The stock's up 60, 70% off of another great year. And so again, by laying out these percentages in this manner, it's super helpful. We do the same thing on a quarterly basis. All right, so the company has reported 2 quarters, Q1, Q2. Here's my estimate for Q3 and Q4, right? So it's helpful to set up. I always have the quarters to the far right and the estimates and the years on the far left. And again, I like to have the percentages underneath. We can kind of track what's going on. So we can see for Meta, as the year progresses, the comparisons, are going to start to get harder and harder, right? But this is, at least setting up the income statement, how I like to set them up. So before I go on to the funds flow statement, any questions? Yes? Do you do the quarterly for all the years or just? I just do. So what I do, and this is my convention, I like to have the year-over-year change. And so if I was to doing this, I would have 22, 23, and 24, right? And so by having 22, it allows me to have the year-over-year change for 23 and 24. So I like to have 2 years of quarterly data and then 1 year of my forecasted data. Okay. You don't have to do quarterlies going back to time. Now, if you're doing this for a living and you've been following the company for 10 years, you're going to have a lot of quarterly data, which you can keep, right? But, but typically you want to have 3 years of quarterly data. And the other thing about the quarterly data, companies, some of them have seasonality in what they are reporting. And by seeing the quarterly change, or the quarter 1 to quarter 2 to quarter 3 to quarter 4, if you can see it over a couple of years, it allows you to forecast, what's going on based on the seasonality. Most people, once they've figured it out, do a pretty good job modeling the income statement. Again, the key is to look at the most recent quarter, read it, and to see what metrics does the company provide me, and then try to think creatively about how I can turn this into a model. Oh, I have one more example. Let me just download this, save, hold on. Apple, right? Company you guys all know and love. Here is what Apple gives us for the 12 months ended 2023. All right? This isn't that helpful. Products and services, you're like, what the hell is that, right? This is what they give us. But if we were to go down, again, we start with the most recent quarter. Oh, but now they give us net sales by category: iPhone, Mac, iPad, wearables, and services. Now we have something to work with, right? So if you're modeling Apple, they don't tell you how many iPhones that they sell, unfortunately, but they do give us a breakdown by category. So this is really helpful. What we can learn from this is like, I can spend all day and all week tracking the Mac. Like, who cares? The only thing that matters is really iPhone and the services. Everything else is a rounding error. I got to get the iPhone and the services piece right in my model. Even if I'm off by a little bit on the Mac and the iPad, it's really not going to move the needle that much, right? And you can see here, we would take this information if we were doing a yearly forecast, and we also have this data yearly. So again, helpful to start with the quarter to help us model the company. And this is what my model looks like, again, going back over time on Apple, right? We can see operating income margins. Margins are very high, right? 31.5%, that is an awesome margin, right? And interestingly, their gross margin isn't that great, but because Apple is who they are, they don't really need to advertise that much because the gap between this and this is not that much, right? Yes, they advertise, but the products kind of sell themselves. And so again, helpful, right, to see, right? So this is what my model is. You're going to say this is one big friggin' company, right? If you were to say they're going to grow this thing 20%, your boss would be good luck, right? So this is just modeling this company. You would say this is maybe a 5 to 6% top line company, right? Just given the size of it. And we can see the iPhone, again, helpful. It really has not grown that much since 2022, right? I mean, they've reached maximum penetration. How they grow today is really by increasing the price of the phone through new features. But you get this by modeling, the company. All right, fun. So this is where I joke with my students. Yes?
Yeah, quick question. I was just wondering, when the historical data, it fluctuates a lot. In your experience, is there a framework, a specific framework?
Yeah, so many times, and this is what's a pain in the ass and you want to break the company's neck, many times you will be modeling the company off of 23 against 22, and then you're doing 24, and all of a sudden the 22, use the most recent release. And don't worry, because they reclassify. It's like accountants have too much time on their hands and they're doing too much. Use the most recent data point if they reclassify information. That happens a fair amount. don't obsess over it. And this, the worst thing is you spend, a year building this model, and then they completely change the whole thing. You've got to start from scratch again, right? So just if there's a change, just use what they're using, the most current. So most of my students handle the income statement pretty well. The wheels come off the cart with the funds flow. This is by far the hardest to understand. And this is where some accounting knowledge is actually helpful. And this is how I do it, right? To me, we need to reorganize the funds flow so that we can interpret as finance professionals, not accountants, right? What are we trying to learn? How efficient is the company at converting net income into cash flow from operations, right? So our first line item in our cash flow statement is net income. And at the bottom is going to be cash flow from operations. The difference is going to be depreciation and amortization and usually, working capital trends, right? We're attracted to companies that are very, efficient at converting net income into cash flow from operations, right? How capital intensive is the business? The amount of capital spending required to generate the cash from operation, critical, right? Is this business capital intensive or not? Is there excess cash flow? We subtract cash flow from operations and we subtract capital spending to arrive at excess cash flow. If there is excess cash flow, how is it being spent? We care about, our company's shareholder oriented. And if there's a deficiency, meaning capital spending is greater than cash flow from operations, how is this deficiency being financed? We want to get this from the funds flow statement. Unfortunately, cash flow statement, funds flow statement, same thing. The accountants make it impossible for us to determine this by just glancing at what they give us, right? It's by far the most important of the three financial statements. So if you're interviewing and the interviewer asks you, which statement do you care about the most? Always answer the cash flow statement, right? We are finance people. We care about cash flow, right? It shows the cash flow characteristics of the company. Working capital, capital intensity of the business, the ability of the company to convert net income into cash flow, and allows us as finance professors to convert book earnings to cash flow, right? We want to organize it into three parts: cash flow from operations, capital spending, and how is the excess deficiency is either being spent or if there's a deficiency, how it's being financed. So cash flow from operations, this is the first part. We always start with net income, right? This comes from the income statement, right? So if we were forecasting 25, our first cell would be plus G25, which is our net income forecast, right? This is the linkage between the income statement and the cash flow statement. Depreciation is going to be a separate line item. The companies are, hold on, my dog is in surgery. This is my wife. Hopefully everything is up, still no word. Anyway. They are required to give us depreciation and amortization. Critical, right? We are going to add depreciation to operating income to arrive at EBITDA, right? We want to show stock-based compensation separately, maybe deferred taxes separately. Everything else, other non-cash charges, gain on this, loss on that, we don't care. We group it together and stick it in other. It's irrelevant, right? So we stick it in other. And then we want to look at working capital, right? The accountants list 5, 6, 7, 8, 10 historic working capital measure, change in receivables, change in payables, change in inventories, change in accrued expenses. What I like to do is sum them all together and put one line item, change in net working capital. This is what I like to do, which it's easier. And you can understand, is this company working capital intensive or is working capital a source of cash flow? It's hard to discern that from 10 line items going back and forth, right? Adding these up, we arrive at cash flow from operations, and critical that what's on our spreadsheet ties into the actual funds flow statement, right? We are reorganizing it to make it useful, show components of cash from operations, and also detail key accounts that allow us to calculate EBITDA, earnings before taxes, interest, taxes, and depreciation. By organizing the cash flow statement, it makes us easier to value the company at a later point in time. Capital spending, critical, right? We want to understand, is this business capital intensive or not? Critical to compare capital spending against cash from operations, shows the capital intensive nature of the business, highly informative about the type of business being analyzed, and by comparing capital spending against prior years allows you to make a better forecast. By deducting capital spending from cash flow from operations, we see whether there is a surplus or a deficit, and this is critical information. So this is, if you want to call it financing activities, unlabeled after capital spending. If there is a deficit, how is this cash deficit being financed? So if capital spending is greater than cash flow from operations, how is this deficit being financed? Is it debt or is it equity, right? If there is a surplus, meaning CapEx is less than cash flow from operation, how are they spending it? And to me, there's 4 ways that we care about. Are they paying down debt? Are they repurchasing stock? Are they paying a dividend? And on a net basis, netting acquisitions, are they an acquisitive company, right? So companies, if there's a surplus, here are the 4 ways for them to spend the surplus, which we want to see, right? So the net change in cash is the sum of cash flow from operations less capital spending and financing activities. This net change in cash that the company is going to show us, right, should equal what we're showing in our Excel file, right? Now here are some other issues that will drive you insane. It drives me insane. There's something called purchase sale maturities of marketable securities. And you'll see this especially in companies that are highly cash generative. So let's say you're Apple and you're generating $100 billion in excess cash flow a year. The CFO has a decision. Does the CFO want to keep that in the checking account earning 0% interest, or does the CFO want to invest it in risk-free short-term U.S. Treasury securities that mature within 3 or 6 months? Most CFOs invest it in risk-free securities that are short-term duration that allow them to earn 3 or 4% a year now versus 0. Unfortunately, every time they make a purchase, this is shown as a purchase of marketable securities. Every time they sell something, it's shown as a sale of market mature. Or if they hold to maturity, it's shown as a maturity of securities. And these are big friggin' numbers in the funds flow statement that have nothing to do with the company, right? So how we deal with this is we collapse these all together and we show it as, marketable securities net. It is irrelevant. It's just a cash surrogate what the company is doing. The effective exchange rate in cash should be grouped in the other category. Anything that is unusual, immaterial, should be grouped in the other category. And a key check on whether you have captured every funds flow category is whether your net change in cash in your spreadsheet matches what the company is showing. All right, let us go through the Apple example. All right, this is, from Apple's most recent 2023 year. So we're going to start with net income. Depreciation and amortization, we're going to show as a line item. Share-based compensation expense as a line item. Other. Right here, there's just one line. Sometimes companies will have 5 or 6 accounts, so gain or loss from extinguishment, or loss on sale, or, subsidiary, gain or loss. It's like, who cares, right? They list it as a reconciling item. We group it and stick it in other. Here is the change in operating assets and liabilities. This is change in net working capital. They show it as individual line items. To me, this is how I model. I like to sum it and show it as one line item, net working capital change. And you actually, there is some, if you track this over time, there is some, it actually makes sense in terms of what's happening. Importantly, cash from operations, 110, right? This is what we're seeing. We want to make sure on our model, cash from operations equals 110. The next line item is what? Capital spending. Payments for acquisitions of PP&E. We're going to deduct this from this to arrive at excess cash flow. Now you can see this is my criticism of how the funds flow was organized. This number is buried, right? Unless you were, knew what you were doing, it's like, what the hell's going on here? So now we have our excess cash flow, which I'll show you on the spreadsheet. Change in debt. So now anything that is debt related, we sum together. So here, proceeds from issuance of term debt net, repayments of short-term debt, proceeds from repayment of commercial paper net. We sum these together, and the sum of two is minus 9901. The next is share repurchases. Anything that is equity, share-based compensation, we sum together. Payments for taxes related to net settlement of equity awards, repurchases of common stock. We sum these up, 3 and 3, and we get share repurchases net minus 82,981. This is what I was referring to, this nonsense with, basically managing the treasury function, purchases, maturities, proceeds from sale, right? We sum these up, 4, 4, and 4, and we show this as change in short-term investments, right? And you can see these are big numbers, but it typically comes close to 0 by doing this, right? The last piece is other here, 5, other here, 5. We sum 5 up and we stick it in other. And this number here, increase, decrease of 5,760,000, this is what we want to make sure that our model sums to. Now this is the function of all our hard work, right? Net income, depreciation, amortization, stock-based compensation, deferred taxes, 0. Other, minus 6577. Cash flow from operations, 110. Capital spending, 10.9 billion. Excess cash flow. So now we're looking at this company like, oh my God, this thing is a cash machine, right? You could not, this thing generates 100 billion a year in excess cash flow. When we looked at the funds flow statement originally, we had no friggin' idea what was going on. This, by the way, back in 18, this is why Buffett initially purchased Apple. One of his assistants showed him the cash flow statement, and they bought the company hand over fist. At the time, it was selling at a low multiple, generating a lot of cash flow. So this company generated, call it 100 billion in excess cash flow. How was it spent? They spent $15 billion issuing a dividend. They repurchased $9 billion in debt. They did share repurchases of 83 billion. Change in short-term investments, who cares? Other, and this net change in cash, right, is what we show to. Now we're talking, right? This company is very good at converting net income into cash from operations. It is not that capital intensive of business. It generates a lot of excess cash flow. And the company appears to be very shareholder oriented. This 100 billion excess cash flow is basically spent on dividends and share repurchases, right? We did not get this from the cash flow statement initially. Now we have a picture, right? And we can actually track it over time in terms of what has happened with this company. This allows us to forecast the future. I'm going to end it here. We're going to continue with this going. Yes, any questions before we go?
You mentioned how it's important to move net income into net changes or cash flow from operations, but is it equally important to analyze how cash flow from operations
Well, so 25, right? If I'm going to do this, I'm going to start with this net income from my income statement, right? This is where we'll begin. We can make some assumptions on depreciation, stock-based compensation, working capital, right? But, you know, all the components are here, so I didn't really understand. And so what would, before you guys go, important point, which we'll get to next week, I think this is your question. This net change in cash is what we're going to use to forecast cash and equivalents. We're going to take last year's cash plus our projected change is going to be this year's cash, okay? So again, the income statement, cash flow statement, and balance sheet are all interrelated. You got to model all three to really model a company. Okay, we have more. Next week we're going to finish this up and then go into actual forecasting.
And if people didn't see, the meta model is posted.
Yeah, the metal and the Apple model are both posted.
I think just the meta one.
I thought I did. If not, I can post it tonight. I thought I posted the. In fact, I know the meta's posted.
The meta one's posted.
Yeah, isn't the Apple one?